think we're now live. Let's just give the attendees another minute to join and then we'll kick off. Thanks and welcome all who have joined already. We'll kick off in about a minute or so. Okay, it's 12 o'clock. I'm going to take that as my cue to get started. Hello, everyone. Welcome to our session on exits. You've got myself, Anna Faelten, from EY. I'm a partner in the corporate finance team at EY, focusing on technology companies or companies and clients. And I'm going to be chairing the session today. Before we kick off, and I'll let my excellent panel introduce themselves, I'm going to just do a quick housekeeping rules update. So we've got an hour today, and we'll try hard to keep to that time. At the end of the session, we will allow some Q&A, and I've been told the way to do that is to write down your question to the panel in your little chat box. And you can do so when you come up with a question, or even better, wait until the end when I say now is the time for Q&A, and it's probably more likely to get picked up by us all. We are recorded, so that's also something to note. And I think with that, let's kick off. Just a few words from me before I let the panel introduce themselves. We're obviously going to talk about exits. Exit strategies, types of exits, etc. And I think it's a hugely important topic, probably more so now than ever. Clearly, we were living through pretty uncertain and challenging times on all fronts. But the good thing is, at least from my perspective, and hopefully the panel will also share their views, you know, deals are still being done, exits are still happening, value is still being realized. But I think there are changes around preparation, different options available, etc., which are quite interesting and we should try to touch on as well today. We'll also talk about, you know, the difference between local exits or international exits, how to prepare best, how to really make your exit a success. And with me to talk through this, I've got, as I said, tee them up, my excellent panel. I will allow them all to just introduce themselves now, one-on-one, and talk a little bit about themselves, you know, their organization. We're actually quite a diverse bunch in terms of experience, and I think that's going to bring some interesting perspectives. And then I've also asked each and every one of them to just high-level view on their on trends within exits to kick us off. So maybe Ben, first over to you for an introduction.
Thank you very much, and thank you very much for having me as well. I'm really pleased to be here with all of you today. I'm Ben, one of the founders of Breega. Breega is a venture capital fund, founders-led and founders-managed, to be fair, and that's how we launched Breega a little more than 5 years ago now, just because we wanted to create the VC we would have loved to have as entrepreneurs. We have been, you know, working hard and lucky enough to grow quickly and probably be one of the fastest growing VCs in Europe. We currently manage 250 million euros out of nothing 5 years ago, and we kind of focus on early stage investments in tech, bringing our entrepreneurial expertise as well as a strong operations team to sort of help our founders as much as we can. We have an office in London and one in Paris, and we currently have 55, I think, portfolio companies in various different industries. A couple of them have been, you know, in the headlines recently. I think the most recent deal in the UK announced was Moneybox. We had an amazing crowdfunding campaign. So, feel free to go on Breega.com and check us out.
Great, Ben. Jannan, over to you next.
Perfect. Hi, everybody. Thank you very much for joining us today. So my name is Jannan Crozier. I am a corporate M&A partner at the global law firm Baker & McKenzie. In terms of experience in this sector, I have acted for a number of very large corporates, including the likes of Siemens, who have acquired companies, predominantly technology-based companies, and effectively transitioned those companies, their technology, the people into their organization. And so looking at this on the other side, I guess, of exits, and how do you prepare yourselves in the scenario where you want to be acquired by a larger corporate, particularly sort of in the industrial space, because right now that sector is very keen to buy all things technology related. So that's my background. I've been with the firm for about 18 years now, and I've spent time in our Moscow office and our Sydney office, but predominantly I do deals that are global in nature. So really have a feel for all different sorts of buyers across the different jurisdictions and how they run their M&A processes. In terms of a trend that we're seeing currently on exits, I would say, you know, a broader trend, which would be pre-COVID, it was very much a strong seller market. Valuations, particularly for all things technology, continue to be incredibly high. Whilst I don't think that bubble has burst, I think the pendulum is starting to swing a little bit more. And I think companies are being more considered around their overall M&A strategy and how they spend effectively their dollar, and therefore what assets they're going to look into. So I think, you know, what does that mean in terms of exit strategies and process? It means that we just need to be a little bit more thoughtful around how you will position yourselves in the event of an exit, and how you best prepare your business in that scenario. Thanks, Anna.
Great points there, Jannan. And as you can already tell, two very different sort of experiences when it comes to exit. One's found with Ben and Jannan more from an advisor perspective. Maybe we'll come back to valuations. It's certainly an interesting time now with whatever processes are going on, because I think we frankly had a bit of a few months where nothing new was really happening. So the real test, I think, around where valuations is happening now. So hopefully we'll come back to that. Before we do so, we'll let the rest of the panel introduce themselves. It's slightly different, again, experience, and I think some interesting additions here around some other types of exit strategies and how technology platforms can help as well. So we're bringing that to the table with Matt and Myles. Maybe Myles, you'll go first from your side.
Sure. Hi, everyone. I'm CEO of Globacap. We digitize and automate the world's private capital markets. We do that through cap table management, through private placement software, and through secondary transfers, all digital and automated. We're only a couple of years old, but our platform now hosts just over $1 billion of private share and debt instruments for 60 companies and approximately 8,000 investors. So we see a spectrum of both growth and investment, private placement, but also some exit so far. And that what we're seeing is certainly an increasing trend towards staying private. And I think that's predominant everywhere in the market. And the technology exists through us and other platforms whereby you know, a company can actually provide very simple, quick, and efficient secondary transferability for its shareholders, and therefore negate the need to go towards a public exit and actually stay as an operational going concern for longer. So happy to talk through some of that.
Great to have you on board as well, Myles. Finally, last but not least at all, Matt, over to you for an intro.
Hi, afternoon everybody. Great to be part of this session. I'm Matt Cooper. I'm the Chief Commercial Officer of Crowdcube. We are a business that's nearly 10 years old. We are the world's largest equity crowdfunding marketplace. Essentially, we connect retail investors from all over the world with companies of all different shapes and sizes, increasingly from all over the world, who are looking to raise capital. Up until now, that's predominantly been primary capital. We started really small, where we just helped small businesses do seed primary rounds of funding. And as we've gone through the gears over the years, and this form of fundraising has become more acceptable and mainstream, we've worked with ever larger, ever more prestigious businesses. In fact, two of Ben's portfolio companies, Curve and Moneybox, two kind of leading UK European fintechs, both did substantial equity crowdfunding rounds on Crowdcube over the last few months. Many millions of pounds raised in very few minutes, actually, from tens of thousands of people. As I said, predominantly that's been primary equity up until now. We've just released a new product, which we call the Director Community Offer, which takes everything we know about large event-driven primary crowdfunding and gives the company the opportunity to have a partial secondary liquidity event. And we think, given, as everybody's rightly mentioned, that companies are staying private for more than 10 years on average now, and that equity is used as a valuable form of compensation for A-grade talent, for founders to get great people into businesses. We feel, as there is in the US, there's going to be more and more demand from growth stage businesses to have partial secondary liquidity events. And our technology, our regulatory permissions, and our experience enables us to do that very quickly at scale.
Brilliant. Thanks all. And there's some interesting themes there already we should pick up throughout our conversation. But maybe let's start with, if I can call it the why. So, you know, I'm sure the attendees that are joining us, some of whom are thinking about exits, or at least started thinking about the exit strategy. Maybe we start with, you know, what is the right exit strategy? What determines the right exit strategy for a venture? And I actually am quite interested in this point that has been raised already, particularly with Myles and Matt, around, you know, exit sort of publicly versus staying private. And I'd agree with that. You know, one trend is companies are staying private for longer. Maybe Myles, if I can ask you to kick off here, why do you think, what's driving that trend, and sort of how is that shaping the market? And also maybe some comments around how founders and investors should think about the right exit strategy.
Sure. I mean, let's face it, if you know, going public is not necessarily a great outcome for a company that wants to continue operating as an efficient mechanism. It adds a whole layer of reporting. It adds a whole layer of additional cost base that wasn't there before and doesn't necessarily need to be there. The purpose of going public essentially is to tap into a greater pool of funding, where that funding only is available if there's a ready secondary market. So we're getting to the point now between platforms like ours and like Crowdcube, where we can actually have very efficient secondary transferability without being a public company. And something that we've done, for example, is to automate all of the back-end settlement process post private share transfer. Now, an example of that in the UK is you have stamp duty and a stock transfer form that needs to go into HMRC. We've automated that and we've made it entirely digital. So when we've got that type of availability, then it poses a question back to founders. You know, do they still need to go public, or could they potentially tap into a pool of funding that is comfortable enough with actually having some ready access to liquidity while the company stays private? And of course, there's room for both. What we saw in companies like Uber, you know, not a great example post IPO, but still in the lead up to that IPO, there were many tens of millions, if not hundreds of millions of dollars being transacted in private share transfers between existing investors and new investors. Now, all of those, when that happens, traditionally are very lengthy, complicated processes, which require a huge compliance team, an army of lawyers, and quite a long settlement period. So that has driven that push to eventually go public, but actually that landscape is shifting now. So that I think is something that, you know, we're driving, that Crowdcube is driving, and there are some other entities out there as well. And I think when we skip forward, another 5 years, I believe we'll get to a point where mid-cap markets like AIM just don't exist anymore, and the public world is deferred to a point where you get so big that you actually do need a great enough liquidity exchange on a daily basis, which would be reserved entirely for large caps. So I think that's an interesting trend, and we've certainly seen interest in that trend. I'm sure that Crowdcube has received a lot of interest on post their announcement of the product that they just mentioned.
Thanks for that. Matt, do you want to add some color as well from your perspective?
Yeah, we've been kind of aware of a movement in the US for a long time, sort of principally led by a venture investor called Bill Gurley, about the absurdity of the IPO process in the US. This idea of the celebration of the first day bounce in price is akin to selling your house for $500,000 on a Monday and the buyer reselling it for $1 million on a Tuesday, and you celebrating that as a great transaction and a great outcome. And the kind of the way has been led by businesses like Spotify and Slack, who looked at what's called a direct listing in the US, which is sort of bucking the trend of the traditional IPO process. And we looked at what we did, and we looked at what technology we had and what regulatory permissions we had, and just said, why isn't there a reason that if there is a company can point to strong buy-side demand for its shares, principally from its customers and its users, but additionally from our 1 million+ registered investors, why shouldn't we sit in the middle of that and facilitate a transfer or the opportunity for these individuals to buy small lots but many lots of shares in growth stage amazing companies, which in turn gives the company the opportunity to provide a partial liquidity event, perhaps for family and friends that took a really early chance on the business, perhaps for early angel investors that might have been in the company for 6, 7, 8, 9, 10 years, that are well out of their EIS tax relief window, might be getting old, might be looking to use the funds somewhere else to sail off into the sunset on a new yacht. And we took our technology and kind of came up with a solution which now enables businesses to execute a partial secondary liquidity event, where previously they couldn't, where, as Myles said, previously it was a murky world of lots of lawyers, lots of advisors, lots of cost. We can facilitate this in a matter of weeks online. And the net result for the company is not only a cleaning of the cap table and a return of some liquidity to people who trusted them in the early days, but also the ability to build this incredible community of user, customer, shareholders, which is what we've seen with a couple of Ben's portfolio businesses like Moneybox and Curve. There were 10,000 people who loved the Moneybox product enough that they felt compelled to invest $8 million in it in a matter of hours. So we think our solution is amazing for the company. We think it's amazing for retail investors who, quite frankly, do not have the ability to access this asset class at a growth stage anywhere else in the world. Secondaries and investing in later stage venture, Series B, C, D, and beyond, is generally the reserve of the rich and the well-connected. We feel, horrible word, but that we've democratized that process on the primary side, and we're pretty excited about democratizing it on the secondary side as well.
Anna, there's a question. Should we take those now or later?
I think we were saying we should take this at the end, but if these are relevant, I'm just getting them up now. Why don't we go ahead? I think let's go rogue and Myles. I think 1 or 2 are to you, so maybe we'll start there and then move on. Do you want to read out the question?
Yeah, sure. So it's from Ami, who's asking, what is the average cost differential between a public IPO and a private liquidity event on our platform and on Crowdcube's platform? And is there a critical mass liquidity level beyond which it would make sense to go on the public bourses? So I'll take that first and then hand over. So yeah, to do an IPO, generally, let's use the LSE and the AIM market as an example. Typically on a large cap exchange like the LSE, advisors would take approximately, the all-in cost approximately is 2 to 5% of funds raised. So if you're raising 100 million in an IPO, then that's 2 to 5 million. On the AIM market, it tends to be between 10 and 15% of funds raised as the all-in cost, which is quite frankly extortionate. On our platform, it's a few £1,000s to list, and then we've catered more towards an institutional private audience as opposed to Crowdcube, which is a slightly different process. So for that, we just then charge a transaction fee for each buyer and seller in the transaction. Is there a critical mass beyond which it would make sense to go on the public bourses? Absolutely. When you get to large cap stage, then, do we want it? The reality is that the vast majority of liquidity is actually provided by market makers. If your company is not large enough to have market makers actively engaged in providing liquidity to that stock, then look at the AIM market. The average turnover of a stock on AIM is 4% a month, which is nowhere near large enough for a significant institutional investor to take or sell a position. So yes, there is a position at which there is a point at which that and it's really kind of that large cap definition. Once you become a true large cap, and that's market cap of over $1 billion at a minimum, then at that point it does kind of make sense to steer towards a public market, and that's because then you have market makers which can then actually provide more liquidity to institutional investors.
Great. Matt, have you got anything to add to that, or should we move on?
Yeah, just like 1 minute comment. I'm an operator, so we build and have been growing Crowdcube for many years and know all of the trials and tribulations of fundraising and scaling a company and a marketplace. We're actually one of only 3 businesses in the UK that have produced a full UK LA prospectus and not listed on a public market. It's us, Brewdog and Monzo, all for the purposes of doing a oversized crowdfunding round. And it was a horrendous process. It was laborious, it was expensive, it was long. And as Myles said, the costs associated with listing on the AIM market in the UK are extortionate for the company. And that's not one-off costs, that's ongoing reporting requirements as well. That may be why, one of the reasons that activity on AIM has really fallen off a cliff over the last few years. There's been 1 new listing on AIM since March the 1st, 2020, which is really, really suppressed. But the costs of our secondary product, the cost of the company is 0, just some time and effort in executing a campaign. And we charge the seller, which is pretty normal for a secondary fund to come into a growth stage business and require a discount on the current valuation in order to take shares from early hires or angel investors. So cost to company, nothing. Cost to seller, we take a transaction fee.
Great, thanks for that. And do keep the questions coming. I'm going to try now my end to say that that's now been answered. But I'm going to move us on a little bit, just in the interest of time. We've talked a lot about, this sort of one of the first questions, I think, about, exits and probably more in the context of a public exit versus staying private. Maybe, and certainly in the world that I operate in, exits are often mean something else. That's selling to a trade party or selling to private equity, either to realize some value or actually all value from a founder and investor perspective. What, maybe I'll direct this to you, Ben. Can you give the sort of attendees a bit of a quick whiz through various exit scenarios that your portfolio companies are looking at, and maybe some, pros and cons and trends for each of those, and I'm sure the rest of the panel can jump in and give perspectives as well.
Yep. Look, to me, and I think it's important for all attendees to understand, what the term exit actually encompasses, right? Because it's a pretty broad term, and there are very different situations that actually come out of an exit. I think the one thing you really have to bear in mind is that an exit can be, for some investors, it can be a partial exit or secondary or whatever you call it, but like it only concerns, a couple of people into the cap table, or it's a full exit and everyone has to sell their shares. Maybe not exactly the same time, maybe not exactly the same price, because there may be some earnouts and stuff, but that's the other world basically. And to be very once again, they are counterexamples, but to be very simple in the definition of all this, usually you actually end up with a full exit when you're talking to strategic investors, because the reality is that ultimately there is some industrial reasons why they're interested in doing business, and therefore they ultimately want to acquire the whole thing. Whereas when you go for a more sort of a financial partial exit, then it usually only concerns a fraction of the cap table, whether it's a secondary between funds, because funds, early stage funds want to leave and later stage funds want to come in, or because it's an IPO and obviously not everyone can sell their shares, otherwise it's a very bad signaling for the market. So these are two different worlds, right? And as a founder, when you start the journey of fundraising, you really need to be aware of that, because if your plan is to raise money and ultimately be the owner of the business on the longer run, if you go down the sort of strategic exit route, well, there's a very little chance you're going to be the CEO or the full owner at the end, right? And because if it's a strategic acquiring a business, obviously you may become a top employee, you may have shares in the ultimate company, but not in the order of magnitude of being one of the major shareholders of your day-to-day business. And that's something that's super important that you need to think of as a founder, and therefore really think of when you start fundraising, because the only one rule that still remains, whatever route you kind of choose, is that early stage investors need to exit one day, right? And especially professional investors, at some point they have to realize value, they have to sort of get their money back to their own LPs, their own investors, because it's kind of a food chain, right? So you're at the end of it, but on the top of all this, you have pension funds and stuff, and so they invest some of their money into VCs, and VCs end up investing in early stage companies. Therefore, when you accept that money in, you have to bear in mind that at some point you need to realize that value. And it's true that in Europe, as of today at least, IPO market, it's sort of, Myles and Matt were mentioning it, at sort of below large cap are tricky, if non-existent, and they're not, it's not a growing market to say the least. So then you have the sort of secondary financial private equity kind of world, and the strategic play. And if you look at the numbers today, it's probably 50-50 in Europe, more or less, so the chances of you ending up selling your company, if you accept, early stage investors, is probably 50%. So you'd end up not being the owner of the whole thing ultimately. And that's something you really have to think through early on, and especially when time comes for exiting some of your investors. So the typical duration of an early stage investment, goes for 4 to 7 or 8 years. So when the time comes, you really have to think of, which direction do I want to go to? Going down the private equity route, which is, welcoming some other investors on board, changing the dynamics at governance level, probably a different way of looking at your business, which is hopefully more established, probably profitable. So it's not going to be growth and test and learn, or at least not as much. Probably will involve more sort of M&A on your side as well. So you kind of go on the other side of the table. You'll probably acquire a few smaller businesses here and there to expand, versus a strategic play where you sort of become part of a much bigger business. Usually as a founder, there's an earn-out, so which means that there's some of the value that you will get depending on certain milestones, mainly being part of the company, usually some operational metrics as well. So it really kind of gets you to stay on a bit longer, maybe embrace, the new company that you work for. I mean, the vast majority, well, we see a lot of stories of people who actually leave after a couple of years, but I've heard of stories of, and I know some friends of mine who were founders and exited and stayed in their acquirer for 10 years, right? Because they loved the plan, they loved the new direction the company, the business was taking. They had other opportunities because, the acquirer was bigger, with a bigger brand, with other resources, could sort of go and open offices in China or in the US. So it's another play you need to have on top of your mind. So I think they are very different sort of realization of the value, and you have to be aware of that depending on what you want to do with your business. And obviously you can change your mind. I think, along the years, you may realize that, hey, I'm fed up with this industry, or I want to change country and go somewhere else and go for a full exit, or you're still in love with your day-to-day job and want to grow your company and do this with other financial investor, whether they are professionals. And it's true that funds becoming bigger, you can keep your company private longer. That's what we see, because, obviously, IPO at the time was because funds were small and you need access to a broader community of people. Now that we have other solutions to sign bigger checks, you can do this for a longer time. And it's definitely a different play.
Ben, I'm just going to touch on one of the words that you just mentioned that even as a lawyer acting predominantly on the acquirer side still makes me shudder. And I think just one thing to sort of flag, the word earnout. So, we see a lot of earnouts being put on the table. And I think interestingly in this market, we'll continue to see them being utilized. And they're often defined as a way to bridge the valuation gap. Now, to the people on this virtual seminar, one thing I would say there is to be quite cautious in that scenario. Where you are being acquired by a corporate, bridging the valuation gap is an interesting term, because the reality of it is, in order for an earnout to work successfully, your company effectively needs to continue to operate in the same way as it did do. And where you're being acquired into a large corporate structure, often that is not going to be the case. You are going to become part of a bigger machine. You will have different opportunities, different challenges, different calls on your budgets, different ways of accounting things. And so as a consequence of that, what we often see as lawyers is the biggest area for contention comes after closing, where you get into a debate around whether you have satisfied the conditions for your earnout. So I think one thing we would say is we see that as a potential growing trend as the COVID impact creates a divergence in valuations, but earnouts are rarely that successful when you are bought into a corporate structure. When you're being acquired by private equity, or you're being invested in by private equity, the situation is different typically, because what they're asking you to do is effectively reinvest part of the amount you would otherwise take off the table. They want you bought into the success of the business. And so largely your interests are aligned when you're in a PE play, because you will all make more money if the venture continues to be successful. So I just think I wanted to just flag that, because even as a lawyer, I am slightly allergic to the term earnout, because it does create a lot of challenges and a lot of unhappy people generally at the end of that.
No, you're totally right. I think it's a very valid point, and I usually take for granted, and it's the consequence of what you've just said. But I usually take for granted that earnouts are really rarely realized. Exactly for the reasons you mentioned, because you don't play with the same rules anymore, right? So you look at a business which is growing because it had funding, because it was agile, because everything was going into a certain direction, good or bad, but at least you had a certain set of rules. And then you say, hey, we put this number here and you need to reach this, without clarifying the rules you're going to be playing in later. And usually that's exactly what you're saying, right? All of a sudden you realize that, you've been acquired by corporate, and, getting your pass to go to your office takes 4 days, when you were a startup where you could do that, just because by calling your office manager. So it's, it's a bit of a different world all of a sudden. And usually I agree with you, people would set, goals as if, the business was running as usual, but it's not anymore. So you really have to be cautious of that and make sure that you have the right understanding of how are you going to be able to operate if you have an earn-out or a valuation bridge to sort of, realize that value ultimately, and not be surprised down the line of playing a different game.
Great points there, and I think the point on earn-out or somehow contingent structuring for financing the deal or for paying for an asset is only going to grow, right? We're seeing that already, where a significantly higher proportion of the price paid is paid in some sort of contingent structure. So that's not going away. And I think if for anybody listening who's thinking about exit sort of, or indeed even fundraising or partial exits in the next sort of 6 to 12 months, that is likely to be a big part of the discussion. So one to keep thinking about and preparing for. Any other comments from the panel before we're moving on to another part, or indeed questions on this from the audience? I did say we sort of went away from saving all the questions in the end. So I see there have come in some more questions, more focused on the last topic, and hopefully we can follow up with that panelists after the call. But clearly keep the questions coming as well. Otherwise, I'm going to move us on, actually related to what we just talked about. And Jannan, I'm going to start with you here, and then feel free, everybody, to jump in. Clearly, a big part of the exit, as we just heard, there's so many different routes you can go down. Actually, the choice of which route you go down probably does change, throughout your journey, and it should absolutely be considered in that way, I think, because your personal, your personal circumstances change, the environment changes, and so on. One thing that I would argue for, and I probably would say that this is an advisor, but the sort of preparation element to an exit, I'd say that is absolute key. And hopefully you'll back me up here, Jannan, or we'll have a debate. But in all seriousness, how to best prepare, for an exit. Let's I'm sure there are some people on the call who are maybe thinking next 12 months, would want to do something. How do we best prepare? And I think another related point in this is, how do I sort of stay in control of both the preparation and the process, which I think are two great sort of questions for you to tackle. So I'll hand over to you now, and then ask the panel to dive in.
Perfect. Okay, so I mean, I think, as Ben and Myles and others have said, the IPO route, I'm not sort of going to address that. Let's put that to one side, because I think that's going to be a fairly tenuous link in the future. But, if we assume you're going to do a private exit, and that involves PE or a corporate sale of a majority or all of your business, I think just stepping back to process and how do you best prepare for that, you need to start with the question of, what is it that my target buyer is going to be focused on? What is it that they're going to be interested in? And, the broad areas that they are really going to spend a lot of time focused on will be, first and foremost, the financials. So have you got your financials ready? Are they able to be digested? Do they show the right picture? Do the numbers stack up? Secondly, can the people who are in the business today do the job going forwards? Are you ready as a management team? Do you have the right people engaged and involved in the business? How does the day-to-day operations of this business interdepend on the owners, the founders, the people who may achieve a full exit and decide that actually now's the time for them to go and buy a boat and sail off into the sunset? Is that going to create a material issue in the business going forwards? Is part of what a buyer will want to buy, is it you? Is it you as a person, and do you need to stay involved to get the deal away? And then secondly, thirdly, what will happen to your customer base if you are bought out? Will they stay with you? Will the product still be viable in a new environment? How does your business plan look going forwards in a new environment? So broadly, those are the three sort of risks that a buyer is going to be focused on. And then there's the sort of, I guess, legal and diligence risk. And the number one legal risk is going to be, do you own the IP that you are purporting to sell? Is that a clean ownership? Could there be people who come with claims later on? Can you prove that you own it? Does that all stack up? And so again, you know, your ability to be able to explain that. So I think my first point would be is when you're considering an exit and are you ready for an exit, is think about it from a buyer's perspective and what they're going to be focused on and the risks that they're going to look at. Next, build a team. In order to exit your business, there will need to be a team that sits around that, because what you need to ensure is that through any exit process, your business can continue to operate day to day. If the entire management team becomes focused on the exit and misses the ball on your budget, then it becomes a difficult conversation on an exit strategy. So make sure you've got the support of the board, the CEO. Key employees know where they're going to sit on an exit. Will they stay with the company? Can you sew them up with a retention agreement? What's your investor base? How are they going to react? Do you have the sort of customary drag and tag provisions in your articles? Can you force a full exit if you need to? So I think, first of all, build a team that will be focused on the exit. And that, without a plug for the advisors, but that does include having the right advisors on board. Do you need an investment bank? Who's going to be cleaning up your financials? Get the accountants involved early, because the first conversation you'll want to have is around value. Get the lawyers involved to start looking at the company and identifying where you're going to have some risk areas that you might need to clean up in advance. So number one, build a team. Number two, design a plan. Even as a lawyer, I am very big into process and very big into planning. I think it is just fundamentally important. You don't want to be blindsided as part of your exit. If you don't plan, trust me, you will leave value on the table, and that's not where any of us want to be. So, think about the timing of your exit, plan that out, and then work back from there. What do you need to do before you get to that timings point? Get the right support of your key stakeholders in place early on. You, again, don't want to go too far down this planning path and realize that you don't have the required percentage to exit. And make sure that within your plan, you've figured out what sort of customer engagement you're going to have, if any, and at what stages. So I think, point number two would be definitely plan. And then I think the final area to focus on, and I just touched on it earlier on around getting lawyers involved, is clean up your house. I think, just to be quite direct on this stuff, a lot of startups in the beginning, you simply don't have the funds to engage lawyers, to know all the best ways to set up your structure, to bring new investors in. Some may be, but not everybody. And there are some just basic housekeeping that you will need to have gone through in order to be able to operate a credible exit process. Without stating the obvious, sort out your cap table. You need to know who is an investor in your business, what percentage they own, what options you've got, what basis those options have been issued on, work out under your articles how you drag and tag people. So it's those sorts of things. Again, the number of times we've looked at companies and we've spotted some fairly fundamental issues in the ownership structure that then either make the exit very challenging or in fact impossible, is quite scary. So really do focus on what your cap table looks like early on. Governance. again, you know, no matter what, we are all in a world of compliance now, and that isn't just GDPR, data privacy type issues, it's compliance more broadly. You know, any, whether it's a PE or whether it's a corporate, compliance is now at the heart of their diligence. And so you will need to make sure you're able to not just show the bits of papers where you've, you know, quickly put in place some compliance policies, but how compliance is at the heart of your culture. You're not going to have a Siemens acquire you and realize your exit strategy if the compliance is off. That's just not going to happen. So really focus on how your governance and your compliance is sort of worked through. IP, I already mentioned, ownership of IP, and that sort of extends to how your employees are employed and what their roles are. You know, do you have IP provisions in your employment contracts so that it's clear the company owns the IP, not the employee? If you've engaged consultants, have you put in place the right contract where the consultant has no rights of ownership over that IP and it's all the company's rights? Again, you know, it's sort of a common issue that we see in these companies, but that will be heavily diligenced and will go to the heart of value. And then just another couple of final comments I'd throw out there: tax, financials, accounts, clean them up, have good management accounts. You know, it all goes to your price, your exit price. And then retentions, how you think about how you want your people to stay in this business. What's the value? What are you selling as part of this business? It won't just be the IP, it will be your people as well. Are they going to stick around? And all of that is effectively pre-sale diligence. Try to spend the time, and obviously this is often a challenge because you don't want to spend the time and money until you know you've got a real exit strategy and a process, but that will never be time you know, ill spent, because whether it's now or whether it's later, you need to have done that cleanup and you need to be ready with your process. So I think that's just sort of, you know, what does an exit process look like? Those are the key issues I would say to consider. And then how do you maintain control of the process? You know, I think first of all, have a process. If you have a clear process that you have designed, you will therefore find it is much easier to stay in control of it. Secondly, decide who are going to be the decision makers. There is nothing more unsettling to a buyer, whether it's PE or corporate, not knowing where the position of power and the decision making stands. Is it with the management team? Is it with the major investor? Who's driving that process and able to make the tough decisions and able to bring along the other key stakeholders? Without knowing who's driving your process, what you open yourselves up is to a divide and conquer mentality. So again, really think about who's in control of that. And I think if you can design your process and you have a clear spokesperson who you have empowered to make decisions on your behalf, that will fundamentally allow you to retain control of that process.
Great, some great points, Jannan, and I would just echo the importance of some of the topics that you raised, which take this in no bad way, but they may sound a bit dry around IP and preparing your legals and whatnot, but the number of times we've gone through exits where that hasn't been done and you just get tripped up and all of a sudden the conversation moves from growth and all the exciting things about the company, best valuation, to all these skeletons that, you know, frankly, should have been cleaned up a long time ago, and it's the worst place to be mid-process. So I can't echo that enough. Great
Anna,
stuff.
Can I jump in very quickly?
Yeah, sure.
Jannan, when you great points and great dialogue. When you mentioned cleaning up your cap table, I can't help but jump in there with an absolutely shameless plug. That's what we do. Come to us, get in contact. Our platform takes care of all of that for you. Checks you've done the right filings at Companies House, gives you easy ability to pass your resolutions that need to be passed. And if you need to give your advisors like Jannan or anyone else your access to restricted data, you can do all that stuff. So anyway, shameless plug over. Thank you.
Thanks for that, Myles.
Yeah, I was about to ask, yeah, sorry to interrupt. I was about to ask one thing which to me is super important and will echo what Jannan just said is obviously it felt like a long list of stuff to be doing. Thankfully, you don't have to do this last minute, and if you do, you're in trouble, right? So I think it goes back to what was discussed a bit earlier around once you go down the external investor route, you'll have to exit, and therefore, if you do this, get prepared as early as possible because it's going to happen one day, and you never quite know when. Because obviously, sometimes you have time to prepare the whole process, but sometimes you have someone knocking on your door and saying, "Hey, look, we could be interested in acquiring you for whatever reason," and then all of a sudden, you have to come up with all of what Jannan said around, governance, who's going to talk for the shareholders group, and who's going to represent the company, and all of this. But if the rest, which is more, housekeeping than anything else, hasn't been done properly, well, you'll be over. You'll miss the chance. So as well as you do it for fundraising, and you know that you need a due diligence and stuff ready, and your cap table clean and all of that, do it as well and keep it clean, on a regular basis, because sometimes things happen when you haven't planned them, right? And so you just have to react. And the more you can focus on the last minute things that are last minute because they are, versus the last minute things that are last minute because you haven't done the job correctly, the more successful you can be in the whole process.
Great points there, Ben. And I would just add a final point, because it's something I get asked a lot. The danger of failing a process for any reason, but particularly if frankly you're not ready, or the things that come out of the process that you weren't aware of, but the buyers are picking up, which sort of impact value or appetite, then the reality is you're probably 12 to 18 months from trying again. And I think that's a really important point, because that's why it's so important to get it right and really think carefully before you sort of prepare and launch a process. Because if it does indeed fail, you're going to have to give some proper time between now, you and the buyers and investors, because you're going to have to come back with a slightly different story, or at least a really good answer to what you couldn't answer last time around. So once again, really important points around preparation. We have some questions as well, but I'm just going to continue for the last point, and then hopefully we can come back to some of the questions really at the very end. And those, as I said, we haven't been able to answer. I'll try to chase the panelists after this, and we'll sort of get back to you via the events team. So the final sort of point, I think, which we haven't touched on, but I think is very important, and I know in one of our prep discussions, Myles, I think you raised this. Now is a funny time, right, to go and exit or fundraise, and I think there are different reasons for doing so. I mean, as I said in the beginning, I'm a tech banker, and actually we've seen quite a lot of exits very successfully. But I think other sectors might be in other positions, and I think also some companies, let's not beat around the bush, have to come out and ask for capital in these circumstances, because maybe they're not, well capitalized and so on. And how do you go about doing that? And what's the kind of pitfalls, right? Because going and asking for money now, if in reality you need that, you need that capital at some point in time, it's a quite different dynamic, right? So have you got some perspectives on that? Maybe I'll start with you, Myles, and then I'd love to hear from the rest of the panel as well. And what are really the things to look out for and think about if that's the circumstances you find yourself in?
Yeah, absolutely. Every company that's either on a high growth track plans to raise capital every 18 to 24 months. And so a lot of them probably are raising capital now, unfortunately, in this period. Otherwise, they've been hit in terms of revenue growth or user growth because of this period. I think something which I think is important is to just bear in mind that if you need to get a funding round away, there's plenty of opportunity to do that. There's a lot of dry powder out there. There are VCs, there are PEs that have capital to deploy. You're going to be able to access capital if your business is still fundamentally sound. But at the same time, their investors are looking for are looking for some form of more attractive investment opportunity. That can come in the form of a discounted valuation, which is probably the best thing you can do. And it's a hard pill to swallow sometimes for founders to suddenly take a big hit on their valuation, and particularly to explain to previous investors why they've just had a down round. But the alternative is sometimes for those new investors to negotiate something like an anti-dilution clause or something else which gives them additional rights later on, and that can lead to a lot of problems down the road in future funding rounds and exits. If we come out of this period of COVID and your business suddenly accelerates again, and you want to raise capital pre-exit or go straight to look at an exit, then that's going to be one of those nasty surprises that Jannan was speaking about. So it would just be my recommendation to, if you're going to have to compromise on something in raising funding now ahead of thinking about exiting in the future, compromise on valuation, but try not to compromise on anything else.
Yeah, absolutely great perspective, and I'd agree with that 100%, Myles. One thing we said we would touch on, and I'm keen to do that as well, because no doubt anybody looking or thinking about an exit will think about valuation. That's inevitable. So I'd like to get the panel's view, and maybe again sort of putting your current trend hat on. What are you seeing, hearing, thinking about valuations? Where are we at now? And sort of how would you say that drives behavior around exits? Maybe I'll pick up with Matt first, and then let's go quickly around the virtual room as well.
So I think there's a lot of companies, particularly London, Southeast, but UK more generally, that are adopting CLNs, convertible loan notes, at the moment in order to kick down the road a probably prickly discussion about valuation. That's been amplified by the government's future fund, which was something that we campaigned for very, very early on, and was brought together by the civil service very, very quickly and admirably, and has been oversubscribed now by 2 or 3x, I think, to the tune of about 300 or 400 million. But there are quite a lot of companies doing convertible loan notes that perhaps shouldn't be doing convertible loan notes at the moment, because I think you're just kicking down the road, as Myles said, an issue when we come out the other side of COVID and lockdown and second wave, or whatever that looks like. We are seeing a whole host of businesses that are absolutely thriving at the moment. Companies in FinTech, businesses that are doing meal subscriptions. What it took them 5 years to achieve, they achieved in 5 weeks through March, April, and May. From a crowdfunding perspective, companies are being a little bit more humble, a little bit more honest with retail investors and their users by saying, perhaps the messaging 18 months ago would have been, we didn't need to let you invest in the business, but we're doing you a favor, allowing you to invest alongside Breega or Index or Axel or Balderson. Now it's a little bit more like, we need and want you to be part of the business to help us get through what could be a challenging 12 to 18 months. But as Myles said, most founders are relatively pragmatic, and getting cash into the business, even at a discounted valuation, is preferable to some horrendous terms that you're just kicking down the road.
Great. Ben, Jannan, Myles, any further perspectives on where valuations are likely to be at? Changes pre-COVID, post-COVID?
Yeah, so I think, if you look just broadly at where the market's been over the last 5 years, tech deals have just gone through the roof. So I think as a sector, tech valuations will be more resilient than other sectors, but they are not impervious. And so, I think what we're seeing now is there was already a built-in inflation to the valuation. I think we're seeing a slight leveling out of that. And that's partly also driven by there just aren't as many deals getting done right now, whether it's tech or otherwise. So I do think we have seen valuations drop over the last couple of months, but I still think you will see valuations in the tech sector being higher than in other sectors. I think one of the areas that we haven't touched on now, which I think long term will have an impact on tech valuations, is regulation and this headwind towards significantly greater regulation. So, at the moment, we've got significant foreign investment rules, which will capture a lot of technology deals. In Australia at the moment, from $1 of any deal that goes on, you have to have foreign investment approval. So that creates a natural slowdown in the ability to get deals away, and therefore potentially impacts your ability to take advantage of a current high valuation. And that's being that longer term of getting deals away is being priced into the value of deals. That regulatory scrutiny, which could lead up to the breakup of some big tech companies, particularly in places like the EU, will continue to have an impact on values in this space. So I think my personal perspective on value would be it's dropped slightly, but is still very strong in this sector. But also just be mindful of, I think we are moving towards greater regulation, and that will have a downward impact on value.
And maybe to give my perspective on this, I fully agree with what Jannan and the rest of the team has said, but maybe to add a different angle, I think there's a big discrepancy as of today between the tech world on one hand and the potential acquiring world on the other end, especially on the corporate side of things. I think, if you look at the market today, a lot of corporates still think in terms of, EBITDA multiple, and maybe you are a tech company, so your EBITDA multiple is going to be bigger because you're tech based, but still, to make it non-nil, you still need a bit of EBITDA here and there, right? So, and that's where, the whole tech industry may invest on potential value in the future, whereas the traditional corporates will probably look more at the sort of typical multiple, right? So bear in mind this on the longer run, and don't be sort of fooled by the value you obtain for your latest round versus what your exit may look like.
Great points. I'm just mindful of time. So what I'm going to do is I'm going to first of all thank to my panelists and the participants that engaged with us in this hour. Great dialogue as well. We do have some questions, so I'm going to cheekily ask my panelists if they want to stay on for another few minutes, and obviously any participants that want to hear the Q&A can do so, and we'll continue for another minute or so before we close, because I've been told we're not actually getting kicked off on the hour. So very quickly, I'm going to look at the Q&A here. Somebody had a question, maybe that's one for you, Myles, or indeed Ben. When do secondaries make sense? At what time in the stage of your growth does a secondary type transaction make sense? Comment here is, I've heard it was traditionally at Series B, but a friend of mine did a recently sized secondary with a VC at a seed stage. Are there any shift in trend on this, and how does the UK compare with the US / Asia? So Ben or Myles, can I direct this one to you?
Yep. Look, I'll take that one, and then I'll have to jump on another meeting. But I think secondaries is, in theory, can happen all the time, right? You just need a seller and a buyer, right? So I think it's a matter of finding people who are happy to participate in the secondary trade in a sale. The problem we usually see over here in Europe is, a lot of early stage investors are like, hold on a second, the valuation of the business is very theoretical. Like, we put up this valuation because we need to figure out a way not to dilute the founders too much, but still have an ownership that makes sense as an investor. But the valuation itself doesn't make sense. Like, if you were to sell the business on the next day, it wouldn't be worth what's written on the paper, right? Probably not. let's put it this way. And therefore, that's why realizing some value on a valuation that makes more or less sense is always complicated. And a lot of people prefer putting money into the business so the business can grow and create more value for all of the shareholders rather than spending money onto acquiring someone. Having said that, every situation is different. In some cases, because the cap table is a bit messy, or because you need to take an early founder out, or whatever the reason is, then maybe cash out at the early stage. At early stage, but it's fairly rare, and I would agree that it's more common to see post Series B.
Great,
Yeah,
Myles, do you want to?
Yeah, just quickly, I'll comment. Totally agree. It can happen at any stage. I mean, even in our own as a company journey, we had an investor at our seed stage that bought out some very early investors. It was a small secondary. It can absolutely happen at any stage. There are different reasons for it. You've got to think though, usually if an investor is buying out investors at an earlier stage of the company, then does that mean that the investor is actually looking to essentially, buy you out completely later on because they're trying to get rid of smaller investors at a cheaper price than they would otherwise? Just something to consider. But it can happen at any point in time. And there are simple ways of executing those secondaries now as well on platforms like ours.
Great. Once again, I'm going to have to draw an end to this just because it's 1:05, and I did say early on, I think that's my role to keep it on time, so I'm almost there. No, and listen, I see we have loads of participants still on the call, which is great. So clearly there is more interest. I want to once again thank to the panelists. It's been a great discussion. Thanks for joining, and thanks to all the attendees and also to the events team setting it up. So what we're going to do, as I said, we're going to try to answer all the remaining questions directly, sort of in a follow-up. That's at least what I've been told. But in any case, wonderful to have you all on today, and do take care and stay safe. Cheerio.
Cheerio, thanks.
Thanks a lot.